Welcome back to Carlton for Life. My name's Carlton, and I created this platform to help educate people on how to use life insurance in their wealth building strategy. Today, we're going to talk about using life insurance for college savings, right? How can we use life insurance to save for college for our children? Now, I have two daughters going to college this year. And after doing the FAFSA and all the financial aid, I found out for one of them, we're going to have to spend about $25,000 a year. Now, for a 4 year undergraduate degree, that's about $100,000, right? Now, when my daughter was born, I wasn't even thinking about saving up for college, right? So obviously, it's too late to save, and we're gonna have to come up with that $100,000. But now that I do life insurance, I talk to parents about using life insurance as a savings vehicle to have a not only a life insurance policy for their child, but also use it as a college savings plan. Now, a lot of parents I come across, they tell me, well, I'm already using a 529 college saving plan. So today we're going to compare a college savings plan, a 529 college saving plan to a life insurance policy, right? We're going to talk about the pros and cons of both. We're going to compare the two. And hopefully by the end of this episode, you will be able to make a decision on whether it's a better idea to use life insurance as a savings vehicle for your child's college education or to use a 529 plan, which is the more traditional route. Let's get into it. We want to save for our children's college education, right? Let's say we have a newborn child and we want to save for their college education. Let's say that we want to save $100,000. What I did was I designed a life insurance policy that you would only have to pay for 18 years, and that would, by the time that child becomes 18 years old and you make the last payment, there's at least $100,000 in cash value, right? There's a chance that there will be $100,000 in cash value, that they'll be able to borrow some, and that they'll be able to pay for college, right? Now, I compared it to a 529 college savings plan. So we're going to look at both. We're going to look at first the pros and cons of a whole life insurance policy that's paid up at 18 and has the potential to have $100,000 in it by the time that child is 18. This is for a newborn female because, yes, there are differences between female and males because females live a lot longer than males and they have different life expectancy. So this particular policy was for a female newborn child, right? It was $374 a month. So you would pay $374 a month for 18 years. Now, to those who are saying, well, $374 is a lot of money, I agree. Yes, it is a lot of money. But if you want to save up $100,000 in 18 years, that's how much you got to pay, right? So obviously, if that sounds like too much for your budget, then you can scale it to what you're thinking, right? If you're thinking more like, well, I could probably save 50,000 for my child's college education or 25,000, then you can imagine this number would be a lot smaller. It all depends on what you're trying to do. I did $100,000 because I'm looking at my daughter's education right now and how it's going to cost her 25,000 a year. So I did $100,000, right? So 374 is around what you're going to have to pay monthly to have that $100,000 in cash value in a whole life insurance policy, right? If you pay $374 a month for 18 years, the cash value in the policy will be around $103,000. Okay. Now, 374 times 12 times 18 years is about $80,000, right? 80,800. That's how much you're putting into this policy, and you're hoping that you'll have a cash value of $103,000. Let's talk about the pros of a life insurance policy and why we should do it, right? The pros: there are no limits for the use of funds, right? So with a 529 college savings plan, they will tell you what you can do with the funds. And if you try to do something else with the funds, you could possibly have to pay a 10% penalty, right? These funds in a college savings plan are only for educational purposes, right? College books, college tuition, even if you're going to use it for K through 12, some private schooling for K through 12, all educational. With a life insurance policy, you can use this money for whatever you want. That's a big pro. Another pro: no impact on your FAFSA, right? If you use this life insurance policy and you have $103,000 in there when your child is ready to go to college, you don't have to declare that amount to FAFSA and it doesn't affect your financial aid. So that's definitely a pro. For a 529 plan, it does have a small impact on your financial aid contributions. So you do have to let them know you have a 529 plan. Not so with life insurance. Another big pro, no penalties, unrestricted access to cash whenever, right? So during the course that you're putting this money into this policy, over the course of the 18 years, you have unrestricted access to this cash. There are no penalties for accessing this cash for any reason. For example, let's say 10 years in, let's say your furnace goes bad, right? Now you're saving this money for your child's education, right? But stuff happens, right? Life happens no matter what. Let's say that you have this life insurance policy. By the time your child is 10 years old and you've had this policy for 10 years, probably be about 40 something thousand dollars in there, right? Let's say there's like $40,000 in this life insurance policy cash value. You could access that cash value through a loan, right? You can take out a policy loan, take care of whatever emergency situation you had, and then you can put it back later on and get right back on track to saving for your child's college. Would do you want to do that? Would you do that? Maybe you're in a position that you don't have to access your child's college savings money to handle that. But what if you are? You do have the option here. If you had a 529 college savings plan, it doesn't matter what you had in there after 10 years. You cannot touch that money. That money is for educational purposes only. So definitely a great benefit, right? God forbid something happens, you can access that cash for whatever you want. Paid off life insurance after 18 years. Another big benefit. You will have a paid off life insurance policy. Let's look back over here. For this policy that was $374 a month, after 18 years, it will be a paid off $718,000 life insurance policy. At 18 years old, not only will your child have a cash value of $103,000, they will also have a paid off $718,000 whole life insurance policy. That is a lot of money. Huge benefit to this. A 529 plan is not going to give you a death benefit, and it damn sure ain't going to give you a whole $700,000 of paid off life insurance. Lastly, tax free growth plus withdrawals. This money grows tax free. This account, this life insurance policy that I designed here is from a mutual life insurance company. It pays a guaranteed interest rate and the potential to earn a dividend. This specific company that I ran this illustration for and got these numbers for has been around and paying dividends since before the Civil War. Every single year since before the Civil War, this life insurance company has paid a dividend, and they have a guaranteed rate. So your money is growing tax free. And if you want to withdraw it through a loan at any time, unrestricted, you can access it. These are the pros of having a life insurance policy. Let's talk about the cons. Lower growth potential, right? So it's not going to grow as fast as a 529 plan. With a 529 plan, you're putting it in mutual funds. You're probably going to get a better rate of return because there's more risk involved, right? This life insurance policy has a guaranteed rate and a potential to earn a dividend. That's a lot less of an ability to grow than if you had put it in a mutual fund. Okay, so let's start there. The growth potential is less, right? For this $374 a month, you're putting into this life insurance policy, that money's not going to grow as fast as it would have in a 529 plan. So let's start there. Second, access to cash requires a loan. You must stay on top of the potential loan interest, right? So let's talk about that for a second. This $103,000, you'll like, so for instance, let's use an example. Let's say my daughter had this policy, right? She had $103,000 right now that she could access to pay for her first year of college. She would borrow $25,000 for the first year out of this policy, right? Now, had she had a 529 plan, she would just withdraw the money out of the 529 plan and wouldn't have to worry about borrowing anything, and that would just be it. It's going to take a little more maintenance and work with a life insurance policy, right? Because you're borrowing the money. What happens with a loan? The life insurance company gives you a loan, understanding that you have $103,000 in cash value. They're going to give you a loan. So let's say they're going to give my daughter a loan of $25,000 at, let's say, 6%. They're going to tell my daughter, we're going to give you $25,000 at a 6% yearly interest rate. Now, remember, that's not money that she's physically pulling out of her cash value. Her cash value still is going to be $103,000, right? What's happening is the life insurance company is using 25,000 of that 103,000 as collateral. So they say, hey, here's $25,000 of our money at 6%. But the life insurance company is still paying her a guaranteed interest rate on her full $103,000. There also is a potential to earn a dividend on her full $103,000, even though she's borrowed 25,000 of it. So if you do the math on that, right? If you do the math on the fact that they're going to charge her 6% on 25,000 while they're paying her, let's say, a guaranteed interest rate of 4% and the potential to earn a dividend of, let's say 4%, right? For to make it simple, let's say they give her a guarantee rate of 4% and there's a chance she earns a dividend of 4%. That would have been 8%. So that year they would have paid her 8% on the full 103,000 while she had to pay them 6% on the 25,000. Chances are she's not going to have an interest payment to pay, right? Because the money that they're paying her on her cash value should wash out the interest that they're going to charge her on the loan. It takes some maintenance though, right? My daughter is going to have to pay attention to this life insurance policy and make sure every year that interest is not owed, right? Was that dividend paid? As long as the guaranteed interest rate was paid on 103,000, probably won't owe any interest, but it's important that she pays attention to it. Now, I say that's a con because with the 529 plan, it's a lot easier. You just pull the money out, you pay for college, don't worry about it anymore. This takes a little more maintenance and it takes some paying attention to. And by the way, it's a loan. Does she have to pay the loan back? No, she doesn't. If she never pays that $25,000 back, they would just take it out of this death benefit, right? When she passed away. So what she would have to do is just pay attention to that interest. Make sure that the interest is always paid. Once she gets to a point that maybe interest needs to be paid, then she might want to consider paying it back, right? I would advise her to pay it back anyway, right? You're in college, there's no payback schedule, right? So she can take her time paying it back. She just has to make sure the interest is taken care of, and she can get through college every year, borrow 25,000, pay off her college, and then once she graduates, she can treat it. I would tell her to treat it like a college loan, right? With obviously with a lot less interest and more of a flexible payback schedule. She can take her time paying it back. I would advise her to just pay it back, right? Pay it back, get that cash value back into that life insurance policy, allow it to keep growing because she's at 103,000 cash value. If she eventually puts that all back after college, after she starts making some good money, then that death benefit will keep going up. The cash value will keep going up. This policy can continue to be a great asset for her as she continues on in her life. No tax deduction. So a 529 college saving plan, if you contribute into that, a lot of times the state allows you to deduct that contribution, right? You won't get any deduction for contributing to a life insurance policy, right? State doesn't care that you're paying into a life insurance policy. That's something that the 529 plan will have that the life insurance policy plan won't have. Lastly, you must qualify for the policy, right? This life insurance policy that this newborn female got, the parent had to qualify for it. So every company is different. Some companies require that all of your children, all of the siblings, have a similar policy, right? Like you can't get one life insurance policy on one of your children and nothing on the other ones. They're also going to require that you have some life insurance, right? If you don't have any life insurance, then a life insurance company might be like, well, why are you getting life insurance on your child? They have requirements and they'll ask you, do you have life insurance? And do all your other children have life insurance policies? These are things that are needed for your child to get the life insurance, right? And also, God forbid your newborn had some complications, some health complications. Maybe for some health reasons they may not qualify for life insurance. So it's something to think about, right? It's not guaranteed that you'll get life insurance. So that could be a negative thing when it comes to life insurance. So I mean, the most important thing that I think I want to pay attention to when it comes to using life insurance to save for your child's future is that while there is a lower growth potential, it's not going to grow as much as a 529 plan would grow. You can't beat this $718,000 paid off life insurance policy. That's something to remember, right? So even if the 529 plan grew faster or had more cash, I mean, the fact that it doesn't come with a paid off $718,000 life insurance policy, that's something to think about. Now, how would a 529 college savings plan look if you put $374 a month into it? I did the math at an average of 6% annual gains. If you put $374 a month into a 529 college saving plans, and on average across 18 years, it gains 6%, which is likely if you put it in the market, right? You would have, after 18 years, $142,000, right? That's after putting $80,800 into a 529 college saving plan. You would have the potential to have $142,000. That's about 40,000 more than the whole life insurance that we just looked at, right? So, like I said, the growth potential is greater, right? $40,000 is a lot more money to have for college savings, right? Now, let's look at the pros. Tax-free growth and withdrawals. So you can grow this money tax free. We love not paying taxes. And when you withdraw it for college expenses or educational expenses, it's going to be tax free, no penalties. That's definitely a pro. High contribution limits. The limits for what you can contribute into these 529 plans is very high. So if you got a lot of money to pour into these things, it's a great place to put it to accomplish your college savings goals. Another pro, favorable FOSFA treatment. I know I said the life insurance policies have no impact on your FOSFA application that you fill out, right? The federal funding that you'll get for saving for money for your child's college, right? This is favorable, right? Like, so the 529 plan, even though you have, in this case, we want to have $142,000, they'll only factor in a percentage of that. So it's favorable treatment for the FOSFA. You get a state tax deduction, another pro, right? For the money, not every dollar, but for the money you put in there up to a limit, they'll give you a state tax deduction, right? So you have to look into your state and see how much they're willing to give you as a deduction. But these are good things, right? These are the pros of a 529 college savings plan. Let's look at the cons. The cons, penalties for non-qualified withdrawals. What's a qualified withdrawal? Remember, this is a college savings plan. So anytime you withdraw this money, it should be for educational purposes. For K through 12, you can use it for private school and things like that. For college, you can use it for tuition, college expenses, but only college expenses. Unlike the life insurance policy, if your furnace goes bad, you're probably gonna have to take out a loan, use your credit cards, do something else. This is not for that, right? But if you're planning on saving for your college, your children's college tuition anyway, maybe you're looking at it like, well, I shouldn't use that for anything else anyway. And if that's your mentality, then cool. This is perfect for you because you'll only get penalties for non-qualified withdrawals. And I guess you're planning on things going smoothly and you not needing this money anyway. So that's good for you. Con is market volatility. It's risky. There's market volatility involved in a 529 college plan, right? For instance, right now the market's down, right? Trump with the tariffs and everything going on, the market's been down. My daughter is going to college this year, right? If she would have had a 529 college savings plan, at the moment that she's ready to go to college, she would have to withdraw that money while the market is down. That would not be good, right? I guess the smart thing to do would be to change your asset allocation into something more conservative as she gets closer to go to college. So if I had a 529 college plan, maybe I would have a year ago put it into something more conservative just in case the market crashed. I know she's gearing up to go to college. Maybe I go more conservative with it. But if I go more conservative with it, I probably don't have this 142,000, right? Because this is on average 6% annual gains. And if I pulled back and went more conservative, I probably wouldn't have got 6%. So who knows what this number would have looked like. But if I left it like that, then what am I down 10, 20%, depending on what the market is? That's the risk with a 529 college savings plan. You got to pay attention to it. You got to make sure that when your child is about to graduate and head into college, you want to pay attention. What's going on with the market? How's your account looking, right? Because if it's down and you got to withdraw the money to pay for college, it is what it is. You don't have much of a choice. It's time to go to college, right? The bill will be due. It's time to start. Another con, I call it money jail. And it's almost getting back to the penalties for non-qualified withdrawals, right? Your money is in money jail. For the next 18 years, you can't really do much with it. If you're using it for college and you're not using it for K through 12 education, and you're like, this is strictly for college, for the next 18 years, your money is locked up. God forbid you have a medical emergency, a financial emergency, you lose your job, you backed up on rent, you backed up on your mortgage, something crazy happens, life happens, we can't predict it. Even if you had tens of thousands of dollars sitting in this college savings plan, you would not be able to access it, right? It's in money jail. Now, for some people, like I said, maybe they're looking at it like, listen, no matter what, I wasn't touching that money anyway. That's for my child's college education. Cool. So that's not much of a big deal for you. For me personally, I don't like my money in money jail. This is a big con for me. I don't want my money somewhere. I would hate to be in a tight situation, whatever it may be, right? A tight money situation. I got 50, $60,000 sitting in the college savings plan and I can't even access it, right? I mean, I wouldn't like that. Even if I had other money, even if I had other access, I'd be like, man, I don't like the fact that my money is tied up somewhere and they telling me what I can't do with it. I hate money jail. For some people, that might not matter. Big con for me right here. The next con still counts slightly against financial aid, right? So although it's a favorable phosphor treatment, slightly it still counts towards financial aid, right? So there is something there. They do take a very small percent, I believe 5 point something percent of your 529 plan that they do account for when it comes to deciding how much money they're going to give you for financial aid. So that's something to think about. And lastly, no death benefit. Big con for me, right? Because although I have $142,000, which, like we said, is 40,000 more than the whole life insurance policy has, what is that 40,000 more compared to when I say that I have a $718,000 life insurance policy paid off? I mean, to each his own, but would you rather have the potential to have $142,000 or 103,000 in a $718,000 paid off life insurance policy? I mean, for me, I'm taking that life insurance policy anytime. An 18-year-old just starting out life with a paid off $700,000 life insurance policy, I'm taking that, right? So I mean, again, to each his own. You have to decide what matters more to you. Some people would be like, man, forget that life insurance policy. I want that whole 142. Again, you would hope that you have that depending on what? Market volatility. What's going on with the market? Do you have that whole 142? Do you even need 142,000? Let's talk about that. Let's talk about the fact that if your child gets a scholarship, a free ride, let's say they end up being an athlete, a magician, a talented student, academically inclined, right? A very smart kid. Maybe they got a full ride. If they got a full ride to college, what you doing with this $142,000? You got 100. Your child gets a full ride to college. You got $142,000. What you gonna do with it? Fortunately, they say that the benefit is you could use it for another child. So now I just saved up $374 a month. I just saved up over $80,000 over 18 years, so that I could go put somebody else's kid through college. I don't like it, right? What if your kid don't want to go to college? What if they want to start their own business, right? What if they like, mom, I don't really want to go to college. I don't know why you saved all that money up over there. Guess what? For the life insurance policy, not only do they have a paid off $718,000 life insurance policy, they got $103,000 they can use to go start their own business. They can do whatever they want with it. They can go get a car. If they, let's say they want to be a real estate agent, they could take some of that money out so that they could, save up and have something in the cut while they're waiting to sell their first property. They don't have to be stressed out about that. They start their own business, literally anything they want to do with that $100,000 instead of with a 529 savings plan where you're gonna be like, man, you almost gonna tell them they gotta go to college, right? Because what else you gonna do with that money? I don't like the idea of not having options. And I think the life insurance policy gives you more options, right? So I hope that this presentation of the pros and cons of a life insurance policy and a 529 college saving plans has given you some insight into what you think is the better option. Some people I know will look at it and say, man, you compare 103,000 to 142, I got to go with the 142. Then you got other people that'll be like 103,000 plus a $718,000 paid off life insurance policy. I'll take that any day. You also have a lot of people that will say that this loan that you have to take out and pay attention to the interest and whether or not they have to pay it back and the interest being offset by the dividends and the guarantee. Oh, it's too confusing. Some people will say that's too confusing. They don't want to deal with all that. They want to take that 142,000 from the college savings plan. They want to pay off college. They want to move on with their lives. I understand that, right? To each its own. I just hope that we are fully understanding what our options are and not just going with the status quo, right? The status quo is the 529 college savings plan. The life insurance policy is a little unorthodox, but to me, I mean, you can't beat it. I mean, call me biased, right? It's Carlton for life. So, of course, I'm going to go with the life insurance policy. Do me a favor. If this information was useful to you, like, share, subscribe, follow my channel, give me some feedback, leave me some comments. What do you think? Do you think you would get the life insurance policy or do you think you would go with the 529 plan? Let me know.